What if I told you there was a strategy where you got paid to buy a stock at a lower price than it's currently trading at? You'd probably be like, all right, buddy, yeah, that's not a thing, or you're scamming me. Well, actually it is a strategy, and it's called a cash secured put, or selling a cash secured put. So in this video, I'm going to talk about both the pros and the cons, and talk about my personal take on the strategy. First step is just understanding what a put option is. So let's look at a blanket definition, and then we'll take a look at an example which will hopefully clarify all the points that are brought up in the definition. Put option is a contract giving the owner the right but not the obligation to sell or sell short a specified amount of an underlying security, aka the stock that you're trading, at a predetermined price within a specified time frame. So the predetermined price, this is also known as the strike price that you would be selling, and then the specified time frame. When you're buying a put option or selling an option, there is an expiration date for that contract. You can sell or buy an option that expires in 10 days or 30 days. So let's jump right into an example to dissect that definition right away. If we're looking at a put option from a buy side to understand it a little bit easier, over here on the right side, this is kind of the setup if you're buying a put on Twitter. We're trading Twitter and we're saying we want to buy a $42 strike price put that expires in 37 days. You can see here's the setup. So it expires December 31st, 37 days till expiration, with a 42 strike price, and it's a put. So that's kind of how you can read it. Over here, you can see that it's highlighted 42 strike price. The bid is 108, the ask is 116, and the delta is negative 0.27. When you buy this, basically what you're saying is you have the right to sell 100 shares at $42 within this period of time. Let's say that the stock goes to 39, and at the end of expiration, okay, yeah, you want to sell at 42 and be able to buy it at 39. You would basically net the difference between those two. You'd make $300 because you're buying at 39 times 100 and selling at 42, and then you lose out on the premium that you paid for the option, right? So that's from the buyer side. If we're gonna say we're actually selling this, the other way to think about it is basically you just flip-flop it. Now, instead of the right to sell at 42, you have the obligation to buy at 42. Let's say the stock stays at 45. You collected, let's say you sold it for the 116 or $116, and it stays at 45. The person that bought the option would never exercise that option, and you would collect the $116 and they would never exercise it. Why would they want to sell at 42 when they can sell at 45? They wouldn't buy at 45 and sell at 42. That doesn't make any sense. Basically, you're selling the downside risk, right? You're selling insurance, essentially. The other aspect that I do want to talk about with options is the moneyness of the options. As you see, as you approach the trading price, the options increase in value. If you're buying the $45 put, that is more expensive than the $42 put. The $42 put is out of the money. There is no intrinsic value to that put option, and it's only time value. Something else to consider when you're selling options or buying options is the expiration date. So you can see that there's 37 days till expiration, and here are the premiums that you're paying. But as you get closer to expiration, the premiums that you're paying or selling actually get cheaper. And as you go out in expiration, they get more expensive. And that's because when you're buying or selling options, there's two parts to the options pricing. There's intrinsic value, which that means the moneyness. So basically, if it's in the money, that's the intrinsic value, and there's extrinsic value, which is the time value. And the other thing is the implied volatility of stocks are different. If I'm selling options for Twitter, the amount that I'm collecting for Twitter may be completely different than the amount I'm collecting for AT&T. AT&T is an old, very stable company, so the volatility on AT&T as a stock is expected to be low. The amount that I'm collecting when I sell an option is also going to be lower than Twitter, that may be seen as more uncertain. Another thing when you're selling options is you always have to be looking at the implied volatility as well as the IVR. I'm not going to go over the specifics of those two in this video, but I may make a follow-up video going into more detail on those specific topics. Let's take a look at the max loss and max profit profile for this trade. So the max loss would be if the stock went to zero and you were assigned at the strike price, meaning you collected $116, but you were forced to buy at 42, and within that 30 days, it turns out the company, Twitter, complete scam. It's not even real. A figment of your imagination, company's bankrupt, complete vaporware. I don't know, some weird world where that happens. That's where you basically have your max loss. The max profit, you have the $116 that you collected, and if that expires worthless, the max amount of money that you can make is the amount that you collected from selling that one option. You may look at that and be like, wow, okay, max loss 4,000 versus 116. You do have to realize this is very unlikely to happen. And another way to think about this is when you sell the put, you're basically, if the stock went to 42, you were assigned 100 shares. You basically made 2.76% on your money within 37 days, which is pretty darn good when you consider 8% for the S&P 500 for an entire year as a good return. And then you still get to keep the stock. Plus, the stock, if it's trading at 45, would have to fall $4.16 from the current price for you to basically lose, or that's kind of your break even on the trade. So that's a 9.24% buffer to the stock in order for you to lose. If the stock stays the same or goes up, you basically win on the trade. You're making the market move against you when you sell a put. If the stock is down and you sell a put, you're basically saying like, bring it on. Like, I don't think this stock can keep on going, but hey, make your move. Make the stock keep on going down and prove me wrong. You have to ask yourself, why are we using this strategy? Why, again, are we selling a cash secured put? And it really comes down to lowering your downside risk and getting paid to buy the stock at a lower price for a long-term trade, or collecting income by selling these puts. I'll explain it a little more. Currently, Twitter is trading at $45. Now, let's say you don't want to buy it at 45. You've done your analysis, and really you want to buy at 42. Instead of waiting around for it to hit 42, you sell an option where you're basically obligated to buy at 42 if someone decides to actually exercise that option and force you to buy 100 shares at 42. Instead of waiting for it to come down to 42, you're already okay with buying it at 42, so why not sell an option and collect $116 while you wait? You're basically getting paid to take that risk of the stock falling further. But here's the thing, you are already ready to buy at 42 anyway. If the stock went to 42 and you bought 100 shares, you could have collected $116 extra dollars. Kind of the thought process behind selling the cash secured put. It's a way to generate additional income or lower the price that you're able to enter a stock for the long term if you don't like the current trading price that the stock is at. You're probably thinking, wow, this all sounds great. I get paid to wait, and basically what's the downside? I mean, I'm getting paid, and if it goes lower, I get a lower price to buy, and I still get the money. So it all sounds great. Well, let's talk about some of the downsides to selling puts. So when you sell a put, you're kind of locked into that price. So if you do sell a put on a stock that crashes, you're still forced to buy 100 shares at that strike price. So you want to avoid selling puts on companies that, one, you truly don't believe in and you're not okay with owning for the long term. And you want to avoid companies that you think there's even a slight chance that could go bankrupt or lose 50% of value. Usually those are the ones that may have higher premiums because they have higher volatility, but something you want to watch out for because those are the ones that may smack you upside the head and catch you off guard. Here's the second downside to selling cash secured puts. If it is a stock that you want to own and you're really holding out for a lower price and the stock just continues to go higher, you may miss out on a lot of gains because you're not getting the same delta exposure when you sell a cash secured put as you would as you just bought 100 shares of the company. If you want to own 100 shares of the company, sometimes it's better just to buy those shares instead of trying to collect income and kind of game the system perfectly by collecting income and getting assigned at a lower price. Sometimes it's better just to buy the 100 shares. As for the pros, in a sideways market, you're still making money by selling the cash secured put. As time goes on and the stock trades sideways, the option decreases in value, and basically you sell the put, you wait, and then you buy it back at a lower price, and you still make a profit. Secondly, you reduce your cost basis if the stock does go lower. So you can basically lock in a lower price than the current trading price, which is pretty awesome. So you're patient and you don't want to buy that stock at the current trading price, and you do want to collect money and lower your cost basis, selling puts is the move. You're probably thinking, all right, enough chit chat, like what's the strategy that I use? Here it is. For me, I'm not selling puts on any meme stocks or stocks that I think will go bankrupt. That's because I don't want to lock in a buy price for a stock that will crash 50 to 60% in a couple days. 2, I'm looking for an IVR that's over 30 because I want to sell premium that has a little bit of juice or a little bit of extra volatility in there. I don't want to sell it when premiums are low. And then 3, I'm looking for a stock that has been sold off. I'm usually not trying to sell cash secured puts on companies that are at a high of their trading range or like a 52-week high. Usually I'm looking for more stable companies, larger companies that are maybe closer to the bottom of a trading range or a 50-day moving average or a 200-day moving average. Basically, I'm looking for selling a put into a sell-off versus selling a put into a rally. When I'm selling puts, my usual strategy is to sell the minus 0.3 delta put. That's my own personal strategy. Now, depending on how much, theta you want to put on or how much income you're trying to generate, the closer to the in the money you get, the more income you're going to generate. As you approach at the money, you're going to take on more risk in terms of assignment. So a way to gauge the probability of getting assigned on the put that you're selling is kind of looking at the delta. So you can use it as a proxy. You can basically say 1 minus the delta is the percentage that you won't get assigned. Or another way to think about it is if I sell the 0.28 or the negative 0.28 delta, there's probably a 28% chance that I get assigned on this option. This is kind of a back of the envelope way of calculating it. Well, there you go. That's how you get paid to buy a stock at a lower price than it's currently trading at. If you did enjoy this video, please consider giving a thumbs up and consider subscribing to Main Street Wolf. Thanks guys, and have a great day.